Good afternoon, everyone. Happy Sunday. It's 10:15 a.m., May 3rd, and I have Faisal here to discuss our weekly equities analysis. Faisal, welcome.
Hey, great to be here.
Good having you, man. So, Faisal, obviously, we got to start off with coronavirus, right? It is obviously the hot topic of March, April, and even now going on to May.
Hot topic of
And
the
we're
world, yeah.
hot topic of the world. We're now topping close to 62, 63,000 deaths in America. And, one stat that I read was, the Financial Times analysis stated that there's about 122,000 more deaths unaccounted for in all hospitals across the world. And it seems like, coronavirus is, as we know, it affects those that are older and those with disproportionate, disadvantages due to high blood pressure, heart disease, cancer, etc. Right? So you may still have heart disease, or you may still have cancer, you may still have high blood pressure, but it's coronavirus that's triggering the acceleration of that and then eventually causing that death. And I think that's what the hospitals are having trouble with. Now, with that being said, right, as the death count increases, I mean, do you think that those numbers are already factored into the market, or do you think that if the death toll goes up or we kind of stay on the steady track, do you think that the market is going to start factoring that in and pricing it lower?
Well, I think that's a great question. It all depends on how much the death toll has an influence on the administration's response. So as of right now, even though the death toll is rising, we are still hearing like we reopened partially in Houston over here. And I got to tell you, like I drove by Friday and stuff, and there were a ton of people who were sitting outside. That there were groups of people again sitting, eating. It was not, it was not super populous, but there were definitely a lot of people out. And so I think the increase of deaths is only going to be factored in if the administration factors it into their reopening plan. So take that with what you will. I think if the death toll does get high enough, I think there will be more immediate action taken, and we could regress back into a more social distancing society versus what we're doing now. But that remains to be seen.
Yes, great point. So, for our viewers today, I think we have something really interesting to discuss, which is Faisal today is going to take the bullish perspective on things. And I think that's really important because we don't often want to just be too bearish or too bullish. In fact, one should always try to be as balanced as possible and as adaptable as possible in the market as the conditions sort of evolve and emerge. And so I'm really excited to take this, dual, black and white perspective of bullish for Faisal and bearish for myself. So in terms of bearish perspective, right? So let me sort of start off by saying, obviously last week, the numbers again came out to about 3.8 million people unemployed. We have now a total of 30 million unemployed people in America, which is close to about 18% of the labor force. What's your take on that, Faisal? And do you think that that is also priced into the market?
The unemployment numbers, I think everything is so hard to determine. I'm going to be honest. I don't really know exactly if it's priced in, but like I said, it kind of goes with the same with the deaths. I think the rate of unemployment skyrocketing really prompted the sharp response of the Fed and the government. So that's good. They kind of got ahead of the curve on that front. But I don't know. Here's the deal. I think even if the unemployment level rose to really astronomical levels more so than now, you would have a Fed that would be willing to respond instantly. And regardless of what you think the outcomes of the Fed stimulus will create in the long term, you can't deny what it's doing for the market right now. It's really given the market the fuel it needed to push higher from those lows. And I think it's created a substantial floor as time has gone on for the market itself. So I don't really know if we're going to break those lows that I really thought that we were going to do beforehand, because the Fed has shown no matter how bad it gets, we are willing to act very soon and very fast. And I think that's so important. And everyone's heard the saying, "You don't fight the Fed." Well, I think that's totally true in this crisis. And in the end, I think we will come out of this crisis. Things look good on the vaccine and treatment side. Um, so I think there is some stuff to be optimistic about, and to think that the worst maybe has been is over.
That's
you know,
that's a great point. Let me sort of touch upon that a little bit, because I want to have this discussion where you mention points, and I kind of want to have a back and forth debate on it. So one thing that you mentioned is the Fed creating a floor. Now, I understand that there can be a floor created, but what I don't understand is, with the floor, I think Fed is unnaturally, in a sense, distorting the market and pushing it up by, as I mentioned to you, and obviously that they're buying investment grade bonds, they're buying junk bonds, which actually has never really been done before. This to me seems like a more distortion from the Fed rather than creating a floor. And it seems like what we're really doing is delaying the imminent, which is a further collapse in the market in pretty much all sectors. So do you believe that it's creating a floor, or do you think that the asset prices or valuations across the board are very skewed?
In some areas, yeah, you could say valuations are skewed, especially since companies have withdrawn yearly guidance. So you're not really able to get a good read on current valuation or forward, PE levels at least a year out. But when you look 2 or 3 years out, I think they're fine. And that's what companies are expecting in terms of a recovery. They're really in multiple sectors, software, even housing, industrial, they're really expecting a pickup in 2021, 2022. So if you kind of look at those valuations, sure, that's fine. But in my opinion, I agree those numbers are shaky themselves. They could really change come next quarter. I think that's the level of risk we're at today in uncertainty. But as far as the Fed putting a floor, like, they have yet to buy a bond. Like they have yet to actually purchase an investment grade or actual bond asset yet. But just from saying that they're going to do
Yes.
that, I think they really added that psychological floor. And I think that provided a ton of liquidity during a time where there was a massive liquidity problem because everyone was so scared. And so I think the Fed has done enough. And as far as, from a psychological perspective and calming the markets, but every other country's Fed or monetary structure or whatever facilitator is doing the exact same thing. It really helps that we're all in the same game together. And so even though the Fed is doing this massive distortion as far as stimulus, every other country is doing the same thing, or every other fast growing developing or developed country is doing the exact same thing. The ECB and I'm sure China has too. So
Right.
when we're all on that level playing field, it really doesn't create distortion rather than set a new standard for how things operate, in my opinion.
See, I would argue that the stock market in America is far bigger of a bubble than the markets, let's just say in, Japan or China or maybe even other EM markets. So my point is, we've spoken about how earnings themselves over the last several years, and you may disagree upon this, they seem to be, again, in a sense, propped up, because a lot of the earnings were statistically coming in favorable due to buybacks, due to dividend structures that were created. For the last several years, we even looked at data 2 weeks ago, I think, showing that earnings themselves were actually dropping off, and company growth was actually dropping off since 2016 and 17. So to me, it doesn't really make sense to compare ourselves to ECB or other markets, given that obviously everyone has to go through stimulus to keep their economies alive. But there's a difference between keeping your economy alive versus propping up an already fairly large bubble. So I guess what is your opinion on that?
Well, I don't think it's a bubble. I don't think it was a bubble at all. You know, I mean, in some cases, you could say there was revenue decline, but no, there was pretty good revenue growth amongst the big companies that do make up a huge portion of our GDP. Apple was growing 10% for the past, I don't know, like 2 years. A lot of these big companies that did, while you are correct, they did have huge buybacks and really benefited from growing earnings, not even 10%. The bar was raised to, you had to grow earnings 20% plus. I mean, that's huge. And so that's already discounting in the buybacks themselves. But revenue growth was fine for the most part. I don't remember specifics, but I don't remember any feeling that revenue growth was showing massive signs of slowdown while earnings were just gang busting upwards. There wasn't that disparity when I was looking at the companies that I was looking at that time. Maybe it could have happened in a certain sector, but I really don't think it was a bubble. I think there was a lot of fuel as far as technological innovation. Companies got a lot more efficient as they integrated different types of technology, whether it was through marketing or even their own analytical employment software. Companies just themselves created more operating efficiency, and that led to higher profits. So that's also something separate from revenue, but I don't think it was a bubble. I think actually asset prices were fairly fine. I think they were a little bit extended before the virus, but for the most part, most sectors you could not make the case that they were overvalued, in my opinion.
Fair
Especially
point.
if we're talking about trading stocks as far as discounting 2 to 3 years out.
Fair point. Let me dial back to the unemployment numbers again, and we'll connect this back from the real economy versus the stock market. So we talked about 30 million people unemployed, and in 2008 was it? We had about 8.7 million jobs that were lost, right? And so end of 2009 financial crisis, we created 22.4 million jobs pretty much till 2020. And in the last 6 weeks, we actually lost, obviously 30 million jobs. So we basically erased the last 10 years. Now, let's just say, in the next quarter to, I mean, I personally think it's going to be at least a 2-quarter recovery. In the next 2 quarters, right, with the companies that come back, those that actually make it, small businesses that come back, those that actually make it again, I would probably argue that, let's just say, for example, we may lose half the jobs for another maybe 2 or 3 more quarters. So let's just say end of 2021, or we can even take it a little bit more positively, and we can say 1/3 of the jobs will be lost for another year. 10 million people of that 30 million, which is 1/3, that has got to have some sort of meteoric collapse of the market, because I don't see how we can talk about being down from the top only negative 15%, right? I mean, we're down from the top about negative 15, 16% now in 2020. And then when we had the real financial crisis in 2008, 2009, we made it from the top all the way down about 56, 57%. So numbers wise, it just doesn't make sense to me. Even if the Fed is doing whatever it takes to keep the market alive, at some point, the rationale in the market has got to kick in, and 10 million or even 30 million unemployed at some point has to roll into the market. This is where I'm seeing the disconnect. Maybe you have a better explanation for that.
No, I totally agree with you. Like I'm on the same way, and I think you thought about it exactly correct. I think 10 million people by the end of 2020 being optimistic. Like I think that's a terrible case that I'm surprised the market's trading where it's at right now if that becomes reality. Um, you're gonna have a bunch of middle class jobs get wiped out because of this whole energy bust that's going on. There are going to be massive holes in the employment space that are really going to eat up the U.S. growth and the recovery cycles. So I'm all with you. As of right now, though, the market is not discounting that. It's just looking at, okay, the Fed is willing to step in. For right now, economies are trying to reopen up. Let's see if we can get the recovery stage cycle on now. And so the market is just more hopeful and optimistic that those numbers of 10 million will not end up coming to fruition. And that, a hiring spree can come back and business can return as usual. But there are positive signs as well. Like, consumer spending has actually not been that bad. I think the consumer index was terrible, but MasterCard came out on Wednesday and actually noted that they saw some really good signs of stability in the last 2 weeks as far as consumer spending habits, which was a really good sign. I think the market took that very well. And also, same thing with Facebook and Google. They also signaled signs of stability and things not being as bad as they are. But, um, like you said, and like I think, if things get worse, these numbers can change overnight. I think people take too much factor into the current numbers that came out, especially the earnings that came out, and not enough into the fact that these numbers are very shaky themselves, and they could change, in as little as 2 to 3 weeks if the economy shuts down again or we have a second outbreak.
Yeah, and to touch upon that, as traders and investors, we try to do our best to analyze the markets as best as possible, and our goal is really, to be um, able to analyze these markets in a best sense with the lens of the future, right? That's kind of how you make money. You can your ability to see what other people cannot see is really where the money is. And so, with that being said, when we look at markets from the present state, I want to let people know that things could shift drastically overnight. I mean, tomorrow we might have a coronavirus vaccine. Obviously, that doesn't mean that the vaccine is going to be spread across America in a matter of weeks. Sometimes it takes a little bit longer, right? But fact of the matter is, when you and I are looking at the market right now, we're doing our best to look at the current data as well as try to forecast as best as possible with the current data into the future. So just want to let people know that, we're not mind readers, or we don't have a crystal ball or anything. We're doing our best to look at the market in an objective lens as best as possible. Today's lens, I think, is uniquely important because I have you to give me the bullish perspective, and I'm going to take the bearish perspective. So with that, let me sort of roll into um, this tweet that I had retweeted, stating that you can obviously now see U.S. commercial bank loan delinquency rate is more than likely going to start jumping up, given that we have a significantly higher unemployment rate, right? And it seems like when we talk about what's happening in the real economy, which is the small businesses being shut down, people losing jobs versus the stock market going up, I mean, no one can deny that there's a complete and utter disconnect, because for now, it doesn't really seem like there's real credit analysis, real valuation analysis. You and I spoke about this before. It really seems like most hedge fund managers, maybe even larger central banks and institutions are specifically looking at what the Fed is going to say on a day-to-day basis and what they can follow in terms of the Fed's footsteps. What's your opinion on that?
Well, it's not a bad strategy in my opinion. It's definitely something that's worked out for you in the past month. I will say, yeah, it's a little bit of a scary time when valuation doesn't matter, but it's a rare time where I think that relative investing and figuring out just the products that work and don't work, the ones that have extreme uncertainty and the ones that don't, like investment grade bonds and all this stuff, the market has completely rearranged itself to a point where it's telling you what it wants to go up. It's telling you that Amazon getting all-time high is fine. It's telling you that Walmart getting to all-time high is fine. Um, when we had that 30% drop, that was discounting a ton of what the negativity that we're seeing now. The unemployment numbers, the deaths, and even I think definitely the commercial loans. That was kind of the first big thing that was a scare, is how are people going to pay their debts off? And so when you look at that, the first thing you look at is the banks. So banks are the ones that have been, I think, one of the first ones that spotted that had the most risk. So to say, that loan spiking up now, why is the market not reacting to that? It already did. It did with that 30% drop in March. So, like, once again, it remains to be determined how much is priced in. Like, it could be they priced in a 25% increase in loans not being paid. You have no idea, but definitely what it's telling you now is you still got to ignore the bad news that's coming out, because for the most part, that 30% drop priced it in. I mean, that was just the most historic drop in the history of the market, and now we see why.
Yeah. So you think that the market is rallying on optimism that Q3, Q4 is going to get better. And I think this is where I sort of retreat back into my bearish bias, which is that I think it's a very high hope and optimism to think that Q3 and Q4 will get better without problems worsening. So, for example, we already know that. So, I was reading some data about in the next 3 months, there's about $28.5 billion of HYG, which is the junk bonds that are set to mature. So that's about the summertime. And in this particular week, there's about $55 billion in investment grade bonds that are set to issue. Now, obviously, the bond markets being significantly larger, how they play out over the next several weeks is going to be critically important, because I think one thing we know that Treasury yields right here, you can see the 10-year note really hasn't done anything spectacularly well with the market. Now, I've pointed this out before that if you look in 2008, 2009, and if we go to the line chart right here and we compare the S&P 500, okay, let's change this to a different color. And I want to show our viewers something that is critically important to look at in 2008, 2009, which is you could see the bottoming of both the equities and the bonds right here at the capitulation of the market, and then sort of both rising up together and coming out of their respective bearish downtrends. Yet here you can see clearly that the equities markets have actually rallied, but the bond markets are unfazed. How do you score that?
I score that as the Fed wants to keep the rates low. Like I don't think that, I don't think it's good if you start to see, the 10 years start to go back up again. I think it's very positive for the short-term market that rates remain low, especially now, relative to back then when we had a totally different debt structure at the bottom of 08, 09. I think it made sense to see how the rates traded back then versus now. And I honestly, to be honest, I expect rates to remain under 1% for a long time, even as the equity markets continue to rally. I think it'll be a very key factor for the next year to 2 years for the equity markets that these rates remain extremely low and for the most part stable. I think that's the number one thing they got to be is have stability.
Fair point. Let's pivot to Europe and see what's going on there. I retweeted this a couple days ago, and I stated that it looks like Germany, people in Germany now, they're basically doing what happened in the 1929s and 30s, which is the initial trickle of people wanting to withdraw their money or not deposit as much money, which is your typical fashion of a bank run. Now, I'm not saying that this is going to happen, all throughout Germany, but these are typically the initial signs that you see from people's optimism and confidence within their government as well as their financial system start to deteriorate, right? And another chart that I want to show you is if we look at the IBEX, which is the Spanish index right here, the Spain's index. If we look at this on a monthly chart, right, and we already know that Spain is a very struggling economy, this is possibly one of the largest head and shoulders patterns I've ever seen. It's a multi-decade head and shoulders pattern. And obviously, for those of us who are technical traders, I mean, these patterns are typically bearish. Once you start seeing that slide down from the neckline right there, it's usually, a pretty deep and vicious slide. Now, what's happening in Europe seems to be in many ways, for me, a telltale sign of what could happen in America. And I guess, do you think that Europe in some way is going to be a leading indicator of what could trickle down into America? Or how do you look at Europe in the same lens?
No, not at all. I mean, that's just my own personal opinion, but like the growth of our companies and the growth of our economy just compared to them is completely separate. I think the recovery cycles of both of our economies will be completely different. I don't know their debt structure, how everything is. Ours is very bad, as you kind of see now. But we have the capacity to deal with it. We have the innovation to recover from it from the long term. I don't know if Germany or Europe is as, I mean, they got a lot of countries, but I don't know if they're as diverse in products, definitely not technological products, as America is. And I think that's going to be the key for the recovery for the next, 1 to 5 years. So I don't look at them in the same light, but it could definitely weigh down on global markets, or it actually could create more demand for U.S. equities if Europe starts to show it's struggling more so than America.
See, from watching the delinquency rates pile up, and now you can actually start looking at data for defaults on credit cards. It looks like it's the picture for America is becoming a little bit more clear of how the next few quarters are going to go. And this is why it's hard for me to shed my bearish bias, because I don't see how things can get spontaneously better in the next quarter or two, by simply just having this virus go away, because the virus itself is, first of all, still pervasive, but on top of that, the economic damage is not really that easy to recover from. It's not like, obviously, like Trump said a couple weeks ago, we're going to get started by Easter. So if you look if you look closely, it seems like the timeline is actually being pushed further and further out. I think around mid-March or late March, people were talking about mid-May, maybe June. Now what I'm hearing is calls for August and September. Have you heard similar sentiment? And if so, I guess what is your understanding of how the recovery could potentially go? What's your opinion?
I don't think it's going to go that well, to be honest. I really think that still a high risk. We didn't even finish mass testing, and we're already, we haven't been mass tested over here. We're already opening up places down south over here, and it's nerve wracking. But I know a lot of people that are still uneasy. They're not going to go out of their homes. So the recovery aspect is, in my opinion, what the market's taking from it, I think it's too optimistic. And I even think I saw a story about how soft openings went in Georgia, and apparently it went really bad. Like they did not see foot traffic or any type of demand for, and they opened, I think, a more variety of stores and businesses than we did over here in Houston. So they really did not do that good. The recovery aspect, in my opinion, the markets moved from the bottom to the top. I, I I don't know if it's necessarily pricing in a fast recovery more so than that the drop that we had from 30%, which was an indication of extreme fear, was kind of an overreaction because the Fed showed that, hey, we're willing to step in at any time and fix everything. Um, but like I said, this recovery cycle is going to be tricky, and I think it really is going to create a massively volatile time for the market where we will probably be trading in ranges more so than kind of a V-shaped recovery like some analysts expect, or continue to break all-time highs as early as next year. I don't think that's going to be the case. It's going to be a lot more trickier.
Yeah, I wanted to talk about Georgia more. And you said, obviously the uh, reopening did not go so well. And that's very interesting because Shanghai actually went through the same issues. Wuhan went through the same issues. And other parts of the world are actually facing similar issues, because we spoke about this a couple of weeks ago where, restaurants are actually told that you need to somehow force social distancing, and you need to make sure that people are not too congested in your restaurant. So with restaurants already having very razor thin margins, telling a restaurant to cut their capacity by 50%, or 75%, or whatever you need to do to keep that social distancing, that's basically, the road to bankruptcy for the restaurant in any way, right? And on top of that, we're already seeing fewer and fewer people actually going out. So it seems to me that if you look at the Georgia, specifically Atlanta traffic, you can see on average the traffic across the board is down about 60 to 70%. Okay. And this is after the opening, obviously, right? Still, people are, a bit more paranoid. And this is obviously visible in Singapore. You can look at data from Taiwan. For those of you who are watching this, you could check out TomTom data right here. New York City, Houston, I think had a slight ramp up in traffic, but
Yeah, people were out. I'm telling you, people were
right.
out.
Yeah, I think Houston definitely had a slight ramp up in traffic, and obviously, the Texan mindset is completely different than most cities.
Yeah.
Very, very fearless people, Uh, but regardless, I think you're still seeing, as you can see right here. I mean, live congestion right here is still down about 50 to 60% from its original peaks. So nonetheless, whether you open up the economy back again, you let people go out, the fear still resides inside most people. And I think this is where most people are missing the picture that coronavirus has undoubtedly changed the psychology of people going forward for several quarters, several years. And I think that impact on the economy is something that most analysts are still not factoring in. Do you think that's the case?
Oh no, I think they are factoring it in. I think you're totally right on the psychological habits changing in many consumers' minds. I mean, you look at stocks like Clorox, Chewy.com, a lot of these stocks that were not doing so well before because of these new habits that are forming. Like I mentioned before, consumer spending is actually, it's not the same as in a regular recession. We were, for the most part, we were fine beforehand, and then it's just like a sudden drop off where people don't have money. A large part of the income class, whether it's the upper middle class or middle class or even the lower middle class, besides some of the stress they're seeing in some of the labor markets, they have money to spend, and so you're kind of balancing on those sides. As far as there is a demand for products, but the way to get them is totally different, and that's going to be detrimental for the restaurant industry, as you said. But it'll really create some opportunities as we're seeing for these totally online businesses like Chewy, and even in some cases Peloton, which it's really been biting my butt. I haven't shorted it, but I really thought it would go down, and that stock has continued to buck the trend because it's considered a more stay-at-home play. So investors are valuing those types of factors now. And you look at a stock like Macy's, it's not just because they're expected to go bankrupt before, but store traffic was down, and I don't think analysts are expecting, even their own people are expecting traffic to pick back up once this vaccine, or I'm sorry, not the vaccine, but once the economy reopens. So you're continuing to see those stocks go down and hit hard versus the online players. So I think the market is definitely reacting in a more short-term way, where it's valuing the businesses that can operate in the short term versus the long term.
What else are you looking at for the week ahead in terms of your bullish bias?
Yeah. Okay. So the week ahead. Okay. Let me lay out last week. Last week was just unbelievably confusing. There were so many mixed factors. We had a ton of big earnings from Amazon, Apple, Facebook. Got a lot of clarity on what the coronavirus has done as far as business spending, capex spending, and stuff, and where companies see their earnings and revenues for this year. And for the most part, a lot of it remains unclear, in my opinion. I think a lot of these stocks held up far better than I thought they would. I thought initially when they first went down, off the initial numbers, I was like, okay, they're good considering we all thought it was going to be a terrible quarter. But then when they started to sell off, I was like, all right, this is it. This is where the market is going to start to sell off. You're losing key leaders in Visa, Facebook, or I'm sorry, not Facebook, Visa, Apple, Amazon, and they ended up holding pretty well, in my opinion. Like, they did not break down as much as I thought they would, considering there were a lot of questions about whether or not the market was overpricing in too much optimism at these levels. Because these stocks are not at their lows like they were a month ago. The Apples and Amazon is a different beast, but the Apples and the Facebooks and the Visas. So the risk is definitely higher. I think that really leads to an interesting week this week. Even though we closed the week down negative last week, there's a higher chance, based on what I saw, that the market's either going to consolidate this week or continue to go higher. And so I think in this market, it really pays to have both longs and shorts, which is something that I think our service does really good at, because we kind of give ideas on both sides. But that's how you have to play this game. This is a stock pickers market, and there will be ideas that lose and there'll be ideas that win. So just real quick, I got like a long and a short, kind of like what I did last week. Last week I went over Medtronic as my long, and then XRT, that was my short. Both of them kind of did exactly the opposite. Healthcare really took a beating last week, and auto retail really had a massive spike up. But this leads me to kind of like my long of the week for this week, which is CarMax. I think CarMax is one of the diamonds in the rough right now. I mean, I looked at their numbers. They have very, very good expected revenues and earnings for this year and next year. The used car market, surprisingly, has seen a 25% drop in auto sales compared to pre-coronavirus. And you know who the biggest buyer of pre-owned cars is? CarMax. So right now, they are getting their product for cheap, and probably after this coronavirus is done, based on a lot of the data that's coming out now, analysts are expecting, home sales and definitely car sales to still resume at pre-coronavirus levels or close to pre-coronavirus levels. So the fact that CarMax is getting pretty much their main product they sell at a 25% discount means they are going to have a pretty nice short-term quarter, at least for how much they can buy at this time. So CarMax is my long of the week. I think they're a great long-term play in my opinion. And then my short of the week is the utilities, XLU. For some reason, this has been the weakest sector as this market has gone up. And so if you got to short something, I think utilities is one that has not shown me any strength and has probably shown the most weakness out of any sector. So that's one that I would look at to short during the week.
Perfect. Good to know. And I'm really glad we do have that service of providing both the short and the long bias. And I think today's conversation was also particularly important because we got to score off on both sides of where we're coming from. And either way, it doesn't really matter what the market does, right? At the end of the day, you and I and most traders and investors in this market are here to make money. Mm-hmm. So I have nothing vested in a sense for the market to go down or up. It's rather, my perspective and Faisal's perspective on how we see the market changing and adapting. And I hope our viewers realize that.
Yeah, and for the record, all the ideas that are shared on here are our opinions. We just love trading. We love watching the markets every day. And so this is our passion, and a lot of the talk that we do on here is our own opinion. So please discuss with your financial advisor or do your own investment research before making an actual investment decision.
Absolutely. And I just wanted to showcase some of your analysis in here. And it's every single day I get to take a peek at your mind and how you're looking at the market. And I think obviously everyone in our community does as well. We have about 75 to 100 members, paying members in our community, and every single day we're growing. So I hope more and more people join and understand the importance of understanding the equities landscape. And of course, we trade Forex. Faisal constantly provides updates in commodities such as oil. And then of course, our largest part of our community is crypto. So, with that being said, I want to wrap up with the final point of discussing something funny that our users can take away, which is Elon Musk. I think, he's definitely kind of gone off the rails a little bit. When you see stuff like that, when he says, all right, well, Tesla stock is, too high. Do you think that the SEC or anyone could do anything about this? I mean, it's just crazy because as soon as he wrote the tweet, the stock tanked like 10%, literally within, the matter of 2 hours. Did you get to catch that live, or did you get to watch it?
I actually didn't watch it. I wasn't watching Tesla stock at that time, but I saw his tweet and then I saw that people were mad. Like there was this whole thing on Twitter, like I just lost $1 million in my portfolio because you tweeted that one thing. I was like, all right, yeah, you got $1 million. You like 10 years old, okay. But
this
no,
is
I mean,
where this is where Elon Musk actually tweeted right around this particular area right here. And I was watching his tweet come into my Twitter feed, and I was like, "There's no way this is real." And as soon as he said that, this happened right there. A straight, 10% drop, $77, just being chipped away at the market. It was just really funny, and just a funny incident to watch because he's always crazy, and you can always expect some entertainment from Elon.
I know, but really though, I don't know why he would say that at this time, considering like there's so much. Like it's good that your stock is holding up so well during a recession period, but man, I don't know why he hates his own shareholders. I don't get it.
Yeah. Well, last but not least, obviously we got to discuss, how the average retailer is positioned specifically on Robinhood. I found this little data set. I thought this was particularly interesting, seeing how, obviously we know from yesterday's shareholder meeting from Warren Buffett, he's largely staying out of the market. And he believes that there's a quote by his quote and his standards that the market is not providing him any good value opportunities. And obviously the GOAT Warren Buffett saying that versus now you square off, your average retailer in Robinhood loading up on things like Tesla and United Airlines and GE or even Southwest and then Delta. This to me is hilarious, and this to me is like watching a car that's just about to crash and hit the tree. What is your take on seeing something like this on Robinhood? And do you ever feel like, what, when I look at something like this, I just want to short all these and go against, what these people are betting into?
Yeah, I mean, I don't know. Fitbit, really? Like, really? I thought like that's the seventh most bought stock. That's crazy to me. I don't know why. There's been a strange thing. I've had a lot of older people text me, yeah, like maybe around 40 to 50 age. A lot of them like Boeing, and I don't know where this entire thing came because they're not usually investors. But they always ask me, so they go, "What do you think about Boeing?" And I'm like, how do these people even know? I've had maybe like 6, 7 people ask me about Boeing. It's like they're all getting their information from the same place. They're like, I think Boeing is a great stock. And they talk to me about airlines. It was like either Boeing or airlines and something like that. And so that's pretty funny because that's exactly what I've heard in my real life, except for Fitbit. No one has come to me asking me if they want to buy Fitbit. It's usually airlines or Boeing.
I think a lot of people follow the typical news cycle, whether it's on CNBC and MSNBC, basically all these financial networks, and I think they get their quote unquote signals from them. And this is why I think you and I provide a very unique and meaningful service because we actually discuss the numbers behind some of these companies, and also we take a broader perspective and a broader view to most things that some of these networks are really not, they don't have your best interest, right? I mean, they could care less if, you buy Boeing now, then you lose 50% in like 2 months, right? In
Yeah.
some ways, I feel like whenever I watch CNBC, there's sort of a meme or a funny, anecdote that happens in crypto, which is that whenever we see, so this happened a couple of days ago on CNBC, I think they were talking about Bitcoin halving that's coming up, where the supply of Bitcoin actually gets cut in half. And the fact that CNBC mentions something like Bitcoin coming to its halving and then price eventually going up, this is where I think to myself, like, yep, this is a top. This is where I need to get out
Mm.
because these are, marketers, really. I mean, I see them nothing as, marketing tools for the masses. How is your, I guess, perception of when you view these news cycles, and can you plug the viewers into your psyche and mindset of how you absorb this information, what you leave out, and what you take in?
Yeah, sure. So I totally agree with you. Like, usually when you see it on the news, it's kind of too late, and that's a really good analogy that a lot of these guys that recommend these trades, yeah, it's kind of like marketing. Hell, even I'm a little bit like marketing when I'm saying something like CarMax, but um, I think these guys can just say it and move on, and they're totally fine with their life. Like, I don't know. I think for us, I really care about trying to get it right, not just because we're, we don't make much money as the TV dudes, but like I really at this stage, it's just such a passion of mine. I want to try and be right on everything. Um, like when I see the news, yeah, it usually means that okay, now that everyone knows it, sure, the top is coming. But maybe for something like Bitcoin, it could bring in a new type of investor. I don't know because usually CNBC doesn't really report. I think this guy Brian Kelly, he does do the cryptocurrency stuff, but they don't usually report it throughout the trading day or anything like that. I don't think I've ever seen it from 8 to 3 or 4 or whatever. Uh, but yeah, I think I kind of have the same mindset when I see analyst upgrades and downgrades. Like if a stock is kind of close to a really high premium in terms of valuation or even price, it's close to its all-time highs, and I see analysts upgrade the stock kind of late. They were late to the party. They were negative on the stock before, and then they had to upgrade it because the price has gone up too fast. Um, those are some of the best opportunities to either do the opposite. So if someone upgrades a stock, that's kind of a best time to short it sometimes. And if someone downgrades a stock, I find that that is actually one of the best times to buy stocks. So it all depends on how you what the news is, but you're right. Once the news gets out in a mass way, it does kind of change the characteristics of the asset, and in this case, the entire crypto market.
Awesome. Well, fantastic, Faisal. I think that is a great point to leave it at.
Yeah.
Thank you so much for joining, man. And as always, it's always great connecting with you and picking your brain. For those of you who are watching this right now, I hope you guys subscribe. There's a link below in the YouTube description. If you want live equity updates from Facile or Bitcoin updates, trade setups, education, and even Forex trade setups, come join our community. Obviously, all of this is non-financial advice, but I hope you all come join. And I also hope you're safe out there and hope you enjoy your Sunday. All right, Facile, with that being said, you take care and have a good rest of your Sunday.
Peace.